Hi, I'm Edgar Rosales, and today I will be talking about risk and return. First, what are T-bonds? A treasury bond is a U.S. government security with a fixed interest and maturity over 10 years. They are independent to the state of the economy because they are backed by the U.S. government, which can raise taxes and increase revenues to ensure full payment and don't rely on how the market is doing. They are virtually risk-free since the U.S. government has very little risk of default. Now I'll talk about the expected returns for the individual stocks and T-bonds. For the T-bond, the expected return was 3%. For Entergy, it was 7.5%. For Freeport, it was 5.9%, and S&P 500 was 9%. So obviously, the S&P 500 had the best returns overall. Next, I will talk about the standard deviation and coefficient of variation. The standard deviation measures variation from the mean. The more variation in a stock, the more risky it is. The coefficient of variation is the risk to return ratio, essentially. So the CV is a better measure since it both measures risk and return. Now I'll talk about a portfolio consisting of 50% Entergy and 50% Freeport. The expected return for this portfolio was 6.7%, which is a less return than Entergy and more than Freeport. The standard deviation and coefficient of variation are both less in this portfolio, which means it's less risky. Since the stocks perform opposite of each other, it cut down on risk. Now I'll talk about a portfolio consisting of 25% Entergy and 75% Freeport. The expected return was lower at 6.3% than a portfolio of 50-50. The standard deviation drops lower, so making it slightly less risky. Next, I'll talk about a portfolio consisting of 75% Entergy and 25% Freeport. The return for this portfolio was higher than the two previous, but the standard deviation rises, making it more risky than the other two portfolios. Next, I'll talk about a portfolio consisting of 50% Entergy and 50% of the S&P 500. The expected return for this portfolio was 8.25%, which is higher than both the previous portfolios mentioned. The standard deviation dropped from 9% for the S&P 500 specifically to 6% for the whole portfolio, which makes it a lot less risky due to diversification. Next, I will talk about diversification. So if random stocks were added to a portfolio, then the risk associated to that portfolio would drop. Adding stocks to a portfolio lessens unsystematic risk of the specific stocks in that portfolio. With diversification, the cost of capital would change. Next, I'll talk about risk. Market risk or systematic risk is the risk associated to the movements in the market and can be eased by diversification. Diversifiable risk can be eliminated completely by diversification, and it is due to the risk that comes from the possible changes in prices of a security because of its specific characteristics. Total risk is all risk associated, including market risk and diversifiable risk. Next, I will talk about the specific securities versus the market and the slope coefficient line. First, these lines are called the slope coefficient, and they measure the amount of change expected in the y-axis as a result of the unit increase in the x-axis. They essentially measure the beta of a stock. The significance in the distance between the plot points and the regression line indicate errors or outliers in the data. Next, I will talk about the efficient market hypothesis, which states that share prices reflect all available information and that the investors all perceive this information in the same manner. This would mean it is impossible for investors to beat the market, as stocks would all be valued correctly. This hypothesis has very little impact because markets are not efficient, as stocks aren't all valued correctly, and investors don't all perceive the information the same way. Now I will talk about long-term debt to asset ratio. If their debt ratio continued to decrease, then they would be perceived as less risky by investors, which would in turn decrease their beta, and so would need a lower required rate of return since they are less risky.